The trends from this chapter of external sector, which is there in economic survey, has been the source of questions for UPSC for quite a while. Why are we studying external sector in the first place? If you want to understand, consider this like a financial report of India. Basically, when we are talking about the concept of external sector, we are talking about balance of payments. This is nothing but a financial report card of how India is doing financially in a globalized world. But why is it important for the domestic consumption? Why is it important for economic growth story? Let us understand first. You know the formula for GDP is C plus I plus G plus X minus M. This trade component is the predominant aspect of external sector. It has twofold impacts. One, the social impact, because if you are exporting more, you are creating employment, you are handling poverty, and you're also addressing the aspect of financial inclusion and therefore inclusive growth. But more than that, the main reason for studying this chapter is to understand the macroeconomic stability that is achieved through maintaining forex reserves, how it can control the inflation aspect, and the concept of current account deficit and how we can manage it to maintain the economic stability that this country deserves. UPSC has a tendency to ask questions on these concepts, the technical aspects of how external sector will impact Indian economy. What we are looking here is balance of payments. This is nothing but an accounting mechanism which tracks how money is flowing in and out of the system. This can be divided into two parts, current account and the capital account. This is the first area where you can get questions in UPSC. Understanding the components of the current account and the capital account. In short, in a particular year, if the transactions are related to something that is short term, you would find them in the current account. And if they are something related to the long term, that is beyond the financial year, which has a future liability or a future asset associated with it, you would find that in capital account. The transaction will be there in capital account. That's what I meant. So, what is affecting the balance of payments at this point of time? 1. Tariffs. 2. India's inability to use free trade agreements to the fullest, and how the post-COVID world is seeing a fragmentation of the global supply chains, and India should look at this as an opportunity. Let me elaborate that. But before that, let's understand the basic components of current account and capital account. So, in the current account, basically all the goods and services that you would see in the transaction as a trade, you would find them in current account. All the visible components of the current account are the goods that we trade with different countries. Whether we import them or export them, they'll be recorded here. And then there is invisible part. This invisible part will have services. It will also have other incomes and transfer amounts. UPSC has a tendency to ask the components of the income and transfers. You can look at this. Income means the profit, interest and dividend that we get from any investments, that will be recorded here. And transfers will be remittances, that is the money sent by people living outside the country to their homeland. And it can also include donations that a country would get, gifts that would be gifted to the people from outside India. All this will be recorded in the current account. How about the capital account? It will consist of investments, loans and banking capital. All this were again previously discussed. If you want this to be elaborated further, I will be attaching a link. You can check the I button in the video here up there. All the basics are covered in that video. You can go and check there. We understood the step 1, that is the basics of balance of payments. Now let us understand the cause-effect relationship that is involved in various variables of the balance of payments and how it will impact our economy. So we need to understand in this context something called the Global Economic Policy Uncertainty Index and the Trade Policy Uncertainty associated with it. What is the context that we are discussing here in the index? The present deglobalization trend and the increasing trend of protectionism. What do you mean? Here, you need to understand the concept of tariffs and non-tariff barriers. In a increasingly globalized world, we have decided that we should not impose tariffs. What do you mean by tariffs? It is a price or a tax imposed by one country on the imports from another country to discourage them. The purpose is to safeguard the domestic industry. Non-tariff barriers means anything other than taxes or duties. That is, if you demand higher regulatory compliance, stricter quality control on the products, that is non-tariff barriers. Increasingly, we are witnessing countries taking the non-tariff barrier routes because after the World Trade Organization came into existence, these tariffs came down. So this trend is impacting our competitiveness. We will look at various issues that are bothering us going forward. And another thing is, since we are not supposed to go down this tariff route to protect our domestic industry, we are forced to innovate even policy wise and encourage domestic manufacturing, and that's why we have schemes like PLI. That is one of the trend that we are witnessing. How this impacts society is, you are looking at an increase in expansion of the agricultural trade policies. We are having aggressive agri-trade export policies. This will have an impact on inflation. This can be a trend that can be picked up by UPSC and asked in the exam. And we are also witnessing a trend in how remittances from the Gulf countries is shaping up and how the forex reserves are increasing and providing stability to the rupee, which is getting fluctuated due to the global headwinds. We will see that aspect also. Overall, what does the trend from economic survey say? Firstly, in a world that is increasingly getting de-globalized, we are witnessing regional trade agreements increasing. Do we have a data pointer to substantiate this? Yes. From 1990 till 2024, the number has increased manyfold, from 22 to 369. Because of this, overall, India's tariff rate has come down, and China has also been responding equally and cutting down the tariffs. So basically what is happening? The price competition for Indian goods is increasing. We are not able to compete with other countries like China, Vietnam, etc. And therefore, this has certain implications. These implications can be asked as assertion reasoning based questions also. What is the implication that we have to know from this fact that regional trade agreements are increasing? The first one being, we are no longer in a place where we can just resort to tariff based protectionism. We have to see how we can leverage the non-tariff trade advantages. So the policy recommendation from survey is that we don't have to hesitate to go forward and sign more FTAs. Biggest criticism for FTAs is that we don't have the domestic competency. So even if the market reach is increasing, we are not able to utilize it. But because of the free trade agreements, imported goods are flooding the Indian markets. This has got more to do with India's lack of competency to leverage the market rather than the problem with FTAs itself. We are left with no other way but to go for FTAs. As a result of this, we are witnessing policy responses. How? We are seeing more and more sectors getting the production linked incentives. That is, if you produce this and export, you will get some incentive. Maybe in the form of cash or in the form of remission of duties, etc., etc. Also, the biggest complaint for setting up businesses in country is the lack of ease of doing business. In the last 1 decade, that has been the government's focus. Lack of infrastructure. This has increased our logistics cost. So we are forced to go for infrastructural expenditure. So you will see that there is a upward trend in capex. That is a next implication. You will also see free trade agreements being negotiated more and more, because if we are forced to go for WTO compliance, our policymakers will have very low flexibility to impose any tariff-based protectionism to safeguard the domestic industry. We have to work harder. That is the bottom line. So this tariff trend will have an impact on the industrial policy also, because we are phasing out protectionism. We are increasing the production-linked incentives, so manufacturing capabilities are supposed to increase. We can learn from countries like Korea as well. They follow a carrot and stick strategy, wherein if that country is protecting some sectors, let's say for example agriculture, then the incentives for that sector will be based on the outputs. It's like survival of the fittest strategy. And probably India should take that route to protect some sectors, if not agriculture, other high value sectors, and encourage output based incentives. Apart from this, there is implication for trade competitiveness as well, because we are focusing on ease of doing business. And this will even inevitably attract high value exports like electronics, semiconductors, pharma sector, green energy. And this is going to be extremely helpful for India's case. The implication of this downward trend of tariffs is more on revenue for the government. Traditionally, government depended on the custom duties. Now that is coming down because of the reduction in tariffs. We have to focus more on trade facilitation. That is, don't worry about custom duties. Make trade easier, and then we can directly impose the taxes like GST instead of focusing on custom duties. Okay, so one more important aspect we have to address is the tariff inversion. What is this tariff inversion? It's a concept where imported goods, the finished products which are imported goods, they are costing less than the raw materials in our country because of the tariff structure we have. We have to address this as well. And this will have implications for revenue. So these are all the implications that you can get as MCQs because of the downward trend of tariffs. This is what you can expect in MCQs. Now coming to the non-tariff trade barriers. Basically, these are the regulatory hurdles that are probable for exporters. Originally, the intent of the country is not just to create regulatory hurdles. It has got more to do with public welfare. But more and more, this became the most preferred route for protecting the domestic industry. And this is good in a way. Firstly, you are expected to have better standards for your products. Secondly, if you have measures like sanitary and phytosanitary measures, which will protect the health of those citizens, it is a good thing. Other non-tariff trade barriers like export-related measures. Let's say, for example, when India thought that we will not be able to meet the food security of our country, in 2022, we imposed a wheat ban. That is also a non-tariff trade barrier. And sometimes to reduce volatility, for example, in the case of onions, we have the minimum export price. This will ensure that the consumer is protected from price volatility. So this trend of non-tariff trade barriers is increasing, and this is what we have to pick up from what survey says. So the sectors which are most prone to this is agricultural sector, chemicals, and textiles. This is what survey says. Now let's have a look at another non-tariff trade measure of EU. Actually, there are a couple of them. First one being the CBAM. Let's look at them one by one. Imagine a product costs 100 euros for a person importing in UK from any country like India. Another domestic manufacturer would produce the same, but the product would cost 130 euros. The reason for this price increase is that they are preparing this or manufacturing this by preventing carbon leakage, or they're doing their bit to reduce greenhouse gases. And since this will cost a bit more than normal procedures, the cost of the product will reflect that increase. But a consumer who is in UK would want to have that product at the lowest possible cost. So they are importing from elsewhere. But EU says that if that product is prepared in such a way that they are doing nothing to contain these greenhouse gases, the one who is manufacturing in UK should not be at a disadvantage. Therefore, they are imposing a tariff by saying that we are protecting the climate. So, in a way, this is an economic barrier which is masquerading as a green package. The second one is the EU deforestation regulation. Basically, this blocks imports of products which are linked to deforestation, and this will impact the agri exports. Why? Because their goal is to reduce deforestation footprint. Products like coffee, leather, timber, which are hitherto the most exported products to the EU, they will have an impact as well. What is the immediate impact? Indian MSMEs do not have the infrastructure to meet these stringent norms, and this will disrupt the trade flow. Because of this trend, CBA makes exports to the EU more expensive, so companies are choosing to invest inside the EU instead, and therefore FDI is increasing there. I'm also attaching this factors driving India's e-commerce exports as a part of this document. You can download directly from the Telegram channel. Apart from these measures, one important point that you need to know is what survey says in the context of textiles. Out of the 10 export shipments that go out of this country, most of them are cotton. 80% of them are cotton. But the world is moving towards man-made fibers like polyester. It is in this context, the government has come up with many schemes to promote the manufacturing of these man-made fibers. Firstly, we have the PLI scheme as an incentive for producing more MMF. Then we have PM Mitra scheme, which are like the mega textile parks which attract FDI because of the infrastructure that they possess. And to make the products better, we need better R&D, right? So National Technical Textiles Mission. This is the measure taken by the government to improve the R&D on this MMF. Traditionally, India has been depending on sectors like textiles for our manufacturing, but we need to move away from this low-paying textiles or any other sector like leather, etc., and move towards high-value products like electronics and semiconductors. This diversification strategy will improve our exports and also, as a result, our economic growth.